Hello. Welcome back. In this video, we're going to look at order blocks. What exactly is meant by an order block? We know that retail traders are not the ones who move this market. The market's price is moved by institutional traders. So, the orders placed by large institutional traders are called order blocks. As you can see here, it is defined as a zone on the chart where large institutional orders were likely placed, often visible as the last opposing candle before a strong structure breaking move. Now, if we look here, there are two types of order blocks: a bullish order block and a bearish order block. Bullish order block. This is the last down candle before a strong rally. That means we usually look for a bullish order block in an uptrend. We consider the last selling down candle placed at each swing low as the order block. The market movement that comes right after this last selling candle before the rally starts is what we mark as the bullish order block. Bearish order block. Similarly, I have shown an example of a bearish order block here on this chart. That is, the last buying up candle before the price starts to drop is the bearish order block. If you look here, you can see that it is immediately after this buying candle that sellers enter the market. So, we mark this specific candle as the bearish order block. So, why do these orders matter? And why do they become valid zones? Price often returns to these zones before continuing, as we mentioned earlier. Institutional players are the ones placing these orders. If they are moving the market continuously in a specific direction, let's say they are selling, they will come back one more time to retrace and close that initial order. We execute our trades when they come back to close that first order. Only after that will they continue the rally or drop in the market. Here is a simple first-step approach for beginners to spot an order block. Find a strong move. First, you have to find the area where a strong, impulsive price move is happening. Trace it back. Trace it back to the last opposite color candle. As I said earlier, if it's an uptrend, you should focus on the last selling candle. Conversely, if it's a downtrend, you should focus on the last buying candle. Mark the area. Draw a rectangular box or lines to mark that specific zone. Watch the reaction. Finally, watch how the price reacts once it comes back and touches that order block. Now, I have drawn some order block patterns here. These are examples of a bullish order block. First, a low was created here. The last selling candle that formed at this low is what we consider the bullish order block. During a buying phase, the last selling candles at each swing low serve as our bullish order blocks. So, what happens to the price here? The price went up and created a high, and then it came back down to close the previous order. Notice how aggressively the price reacts to the order block. After the price touches it, aggressive rejections happen, followed by continuous buying. So, this order block is valid. Let's look at the next example. A small low was created, and I have marked the last seller order placed there. The price created a new high and then came back down to close the order. After closing the order, the price went up again. Currently, there is another sell order block placed here that is still active. The market hasn't come down to close it yet. However, in the future, the price will come down to close this order and either continue the uptrend or cause a structure shift and reverse downwards. Both scenarios are possible. So we only take an entry after watching how the market plays out once the price reacts at those particular zones. Next, let's look at examples of a selling bearish order block. Looking at the pattern, a high was created, and then a low was created. We need to look at the orders placed at each swing high. For a bearish order block, we focus on the last buying candle, unlike the bullish order block where we look for the last selling candle. Here, the price retraced, closed that buying candle, and then another down move happened, followed by another retracement. It created a new low, then a new high. At this new high, the last buying candle becomes our next order block. The price retraces, closes this buying order, and then a strong down rally happens. Later, the price shifted slightly upwards, created a low, and then reacted to a previous bearish order. It created another high, giving us a new bearish order block, the last buying candle. The price made a down move, had a small retracement, but didn't close the order immediately. It created another low, slowly retraced back up, closed the order, and then continued the massive downward rally. If you look closely, you can see that these massive momentum candles are never printed in the market by retail traders. A retail trader can never achieve this. It is only when institutional players enter the market that such huge momentum candles appear. This entire process is how price reacts to bearish and bullish order blocks before moving. Please watch the video again on repeat to review everything. God willing. In the next video, we will do a live session on a real-time chart showing how to draw market structure, how a break of structure works, and how to identify order blocks within that structure. If you liked the video, please be sure to like it and subscribe to the channel. Until we see you in the next video. Bye.